Your retirement account is about to buy stock in a company losing $5 billion a year. You won't approve it. You won't even be asked. It will just happen automatically because someone quietly changed the rules of the stock market a few weeks before the biggest IPO in human history. That company is SpaceX. That IPO is targeting a valuation of $1.75 trillion. And the story you're being sold about it, the rockets, the Mars stuff, the genius founder, that story is designed to make sure you don't ask the question that actually matters. Who is this IPO actually for? Not you. But you're the one paying for it. Ask 10 people what SpaceX sells and 9 say rockets. The 10th says Mars. They're both wrong. SpaceX is actually 3 completely different businesses wearing one name. And the rocket thing is not even the most important one. Here they are in order of how much you should care. Business 1 is the rockets. This is the brand. The launches, the boosters landing themselves, the NASA contracts, the government satellites. It is genuinely impressive engineering. Last year it brought in about $4 billion in revenue. At any normal company that would be huge. At a $2 trillion valuation it is basically noise. Business 2 is Starlink. This is the real SpaceX. More than 10,000 satellites in orbit, beaming internet down to over 10 million subscribers across 150 countries. It is the fastest growing telecom company in human history. And the margins are what make it extraordinary. 2 years ago those margins were 41%. Now they are 63%. That is not growth. That is a money printer accelerating. Starlink brought in $11.4 billion in revenue in 2025 alone, and it represents 61% of everything SpaceX makes. It is the only reason any of this conversation is even happening. Business 3 is XAI. This is where it gets ugly. Earlier this year SpaceX acquired XAI, which is Elon's AI company that also owns X, the platform formerly known as Twitter, in an all-stock deal valuing the combined entity at $1.25 trillion. XAI's slice of that was $250 billion. Now for context. OpenAI generates $24 billion in annual revenue and is valued at $850 billion. Anthropic generates over $30 billion and is valued at $400 billion. XAI estimates around $1 billion in revenue. It was bought for $250 billion. XAI is priced like it's Emirates. It operates like Spirit Airlines. It gets worse. XAI was founded by 11 co-founders, engineers and researchers from DeepMind, OpenAI, Google, and elite universities. A genuine heavyweight team. By March of this year every single one of those 11 co-founders had resigned. Every one. And then Elon, on his own platform, publicly announced that XAI needed to be rebuilt from the foundations up. The CEO of SpaceX paid $250 billion for a company he then admitted needs to start over from scratch. So in 2025 Starlink and the rockets generated about $8 billion in profits. Then XAI showed up and lit $5 billion of it on fire. The combined company lost nearly $5 billion on $18.5 billion in revenue. That is the SpaceX going public. Not the rockets. Not the satellites. All 3 businesses, as one package, losing billions every single year. Here is what nobody is talking about. On May 1st of this year Nasdaq adopted something called the Fast Entry Rule. SpaceX is reportedly targeting a June listing date. The timing is not a coincidence. The Nasdaq 100 is one of the most important indexes in finance. More than $600 billion in assets track it. When a company gets added to the index, every fund tracking it is legally required to buy that stock automatically, without discretion, at whatever price it is trading at. It is forced demand at scale. Under the old rules a company had to wait at least 3 months after going public before it could be added. That waiting period existed so the market could actually figure out what the stock was worth before passive funds were forced in. The new rule cuts that to 15 trading days. 3 months of price discovery compressed into 3 weeks. But the waiting period was not even the only rule that got changed. There used to be a minimum free float requirement. At least 10% of a company's shares had to be publicly available for trading. SpaceX is targeting a float of 4 to 5%. Under the old rules that would have been an automatic disqualification. Under the new rules the minimum is gone entirely. And then there is the multiplier. Buried in the technical language of the new rules is this: for companies with a float under 20%, Nasdaq now treats the float as 3 times larger than it actually is. A 4% float gets weighted like a 12% float. A 5% float gets weighted like 15%. They did not just lower the bar. They changed what the bar measures. So who buys SpaceX? You do. And here is exactly how the sequence works. Step 1. SpaceX lists at $1.75 trillion. Insiders who have held equity for years at a tiny cost basis now have a path to sell. Step 2. 15 trading days later the fast entry rule kicks in. SpaceX drops into the Nasdaq 100. Every index fund tracking it is now forced to buy. Step 3. On top of that, SpaceX is targeting a retail allocation of 30%, far higher than the typical 5 to 10%. The CFO of SpaceX told a room of bankers on the record that retail buyers have been incredibly supportive of us and of Elon for a long time and they want to recognize that. Translated, the largest IPO in history is deliberately routing supply toward people who are loyal fans, not sophisticated analysts. A portfolio manager named George Noble said it plainly. Your 401k is the exit liquidity. Shares move from insiders at a low-cost basis to passive funds and retail investors at peak valuation. The buyers are forced in early. The sellers get to pick their moment. If you have a retirement account holding any US stock index funds, you are going to own SpaceX within weeks of its IPO. Not because you chose it. Because the mechanism that makes passive investing easy for you also makes you a guaranteed buyer for anyone who can get into the index. And someone just figured out how to skip the line. Here is the corrected picture of SpaceX. It is 3 businesses. One is a genuine money printer. One is solid but overvalued. One is burning $1 billion a month and was just rebuilt from scratch. Together they lost $5 billion last year. And they are about to go public at the largest valuation in the history of financial markets. This is not a SpaceX story. It is not even really an Elon story. It is a story about how the financial system works, who it was built for, who it protects, and who ends up holding the bag when the music stops. Passive investing was sold to you as the smart, simple, democratized way to build wealth. Low fees. No stock picking. Set it and forget it. All of that is true. But nobody mentioned the fine print. The same feature that makes it automatic and easy for you makes you a guaranteed buyer for anyone who can muscle their way into the index. SpaceX just muscled its way in. And Nasdaq handed them the door. If you want to understand how this keeps happening, subscribe. Because this will not be the last time.